what's happening right here is whenever I switch accounts off of this main one, and when I'm on the stock market news one, whenever I switch off it, it completely kicks me off the Spaces. I clicked the notification that I got and it took me to the other account. So that lesson learned, will never be touching a notification I get during Spaces. So we'll blame it on Twitter, but that was my fault. That was completely my fault. So Simon, we were kind of talking a little bit there. I know you got cut off. I would like to throw it back to you. I apologize, and we'll kind of don't give any of the huge points away right now. We'll give our speakers, our crowd, another minute to get back in here. Let me get some extra tweet outs too.
Well, how about this, Evan? How about rather than blaming Twitter, can we blame Elon?
It was a tweet about Elon. So I think we can blame Elon.
I must have said Elon or tweeted something about Elon, and that's why we got cut off. It's Elon's fault this time.
Hey, gentlemen, this is Clayton from OBR Investing. I apologize. I've been having some technical issues trying to get in here. I've never been in the Twitter space before, so my computer and my phone decided to go against me this morning, so I apologize for that.
No worries at all. I guess this is a morning of those type of problems. By the way, for Twitter Spaces, you do have to be on your phone to speak into it. I don't know if you're trying from the computer, but yeah, sorry, Simon. I just want to hear a little bit more about what we're talking there, and then we'll kind of bring OBR into it and let them get introed.
Oh yeah, no problem. I'll pick right up, Evan. I think where I was going with the previous rant that I was on, so to speak, was that the COVID pandemic kind of convinced us that a lot of companies were going to be things that they really weren't. There are a lot of examples from this. I'll just bring up one of them, which was Peloton, which everybody just thought that all of a sudden everyone was going to abandon their gym membership and buy the Peloton bike, which costs several thousands of dollars. And this was the new normal. It was the new normal in the pandemic when nobody wanted to be around each other. But then, of course, we've seen Peloton kind of reverse course. And something we always chatted about is, we thought this was kind of a short-term spike in results because their entire business was something that could just be a feature of a company like an Apple out there. And so for us, who's always thinking long-term investment opportunities, this was not a great buy and hold situation. It was something that was catalyzed by the pandemic. But I mean, stuff like that, it kind of separates out, what is a long-term, legitimate, genuine trend that you need to be taking advantage of versus what is kind of a short-term spike that is really not sustainable. And we saw a lot of those, but on the other side of it too, thinking about what has scared us away from great opportunities during this market sell-off of the last 6 months too. The recommendation that I have for 7 Investing this month, which is my top stock for May, is a company that's down 38% year to date, right? And you might look at that and say, oh gosh, I'm out. There's obviously something wrong with this business. Spoiler alert, there's nothing wrong with this business. It's actually a fantastic run company. We hear a lot about the rule of 40 for software stocks, cloud-based, cloud-native stocks. If you want to have a 40% EBITDA margin or profit margin, and then also a 40% growth rate. This is a company that's got the rule of 80, where it's actually got 40% growth and a 40% profit margin, even in the middle of this sell-off and the inflation and the rise in interest rates and everything else going on with the macro. And so the perspective that I'd like to share today as we're talking about long-term investing, I'm thankful that you have this Spaces, because I think there's a lot of great babies being thrown out with the bathwater that are not going to be as exposed to a lot of these challenges that we talk about when we talk about the macro. But we've got to really do our homework. We've got to do the analysis and the stuff that Brad always brings up in this program too, does such a good job of getting in the weeds and looking at who's fundamentally succeeding out there versus who's kind of going with the trend or going with the momentum and riding up the hype cycle on the way up, but it's going to get crashed on the way down. That's not long-term investing. Long-term investing is built upon fundamentals. And we still know that 50 to 70%, this is from Boston Consulting Group numbers, 50 to 70% of long-term investment returns are tied to profitable revenue growth over a 10-year period. And so let's go out and find the companies that are disrupting or innovating in huge market opportunities, but it's also got to be sustainable. It's got to be profitable. It can't just be a flash in the pan. So that's what we always kind of think about when we're looking for long-term investment opportunities.
Awesome. Sad the amazing information coming out of Simon's mouth there was interrupted by the space going down. We have a lot more coming. Super excited. I guess the best thing is for it to happen at the start, but we're reloading fully back into it. OBR, I want to bring you in here, get a little bit of an intro here. We'll give you a chance to speak a little bit more in a minute. I just want to hear a little bit about who you are, who OBR is in general. I know there's actually a couple of you guys behind that, and then a little bit about what you guys are seeing in the market today, how you're feeling, and just anything in general for long-term investing to start out. But yeah, floor is yours.
I appreciate that. Can you guys hear me all right?
Yep, you're good.
Okay, excellent. I appreciate that very much. My name's Clayton Astor. I am the community engagement coordinator for OBR. So just about all interaction that we see within our server and our company and our socials, I try to take much advantage of that as possible and be as interactive as possible with consumers and clientele, potential clientele. So as of right now, OBR is working on being as comprehensive as possible. We have an analyst panel full of individuals who are day trading, scalping, swing trading. We have myself, who is more of the long term side of the aisle, and that's what I focus on. And I'll go into that in a little bit here. But OBR is doing a very, very good job uh, focusing on our primary, which is our consumers. We take kind of an Amazon perspective where our clients are number one. We try to make sure everybody is taken care of in its totality. And that's happening on a daily basis. We've got live calls, kind of like these Twitter spaces that we run in our Discord. And then we try to project that onto our socials just so that we're getting as much information out to people as possible based on what it is that we're seeing. So I personally am not on the short-term side of the aisle. I know that we are in a long-term space, which is just great because this is what I talk about a lot. And I know a lot of folks who are in the majority of these communities are very short-term minded for the most part. As we look into the long term, I mean, as of right now, I do privatized portfolio management, so I do management for smaller businesses and companies that do private equity acquisitions, et cetera. And I manage the assets for them, and I grow the capital so they have more liquidity to work with when they're going into other businesses. Um, and as of right now, looking at the overall market, it's just been too much fun. I came into 2021 with the most amount of cash I've ever had. I was very close to being about 50% liquid across all of my accounts and across all of my businesses and companies, and that was an incredible decision and I'm very very happy about that. Fourth quarter of 2021, my prediction was based on a couple of different drops that we had previously. And the way that I manage my portfolio is all based on percentages. I don't use a lot of technicals, and I don't need to use a lot of fundamentals because I'm not buying anything that I need to necessarily consider the fundamentals. The fundamentals are all phenomenal with my holdings, and I'll go over that in a second. So uh, I looked back and I was looking for empirical data points that would show kind of the percentage based drops that we'd be looking at in the overall market coming up into a major inflation based economy. And I was very, very excited to see some 15 to 20% drops that we've seen prior. We've seen some very high inflation in the past, and the market responds negatively in the short term. And then we have some phenomenal years to follow once inflation is curbed, which I'm ecstatic for. And that'll be the next couple of years coming up. So as the market's been falling, we've seen some incredible companies such as the mega caps, and I predominantly stick around the S&P SPY, for example, and the Nasdaq QQQ, for example. I stick around those, and I stick around their major holdings. And as of right now, I'm very tech heavy, and I'm very happy about it. And I've got great average costs across the board, and I think they're all on sale. The multiples that we'll be seeing moving forward and where they came down from, Nvidia being almost down 50% from the highs, AMD being down a ton, Microsoft, Tesla almost saw 50% down, right around that 690 support that it was coming down to. I've been picking up a ton of Google, a ton of Tesla, a ton of AMD. I'm restarting an NVIDIA position here. I've been waiting for a long time to get back into NVIDIA. I dumped my entire position of NVIDIA and the 312 level right around there. That was about my average on when I was exiting that position. I got 70% in about 6 months, and that was just too good to leave on the table. So I scaled out of that almost completely. Got back at the 185 level. I hold a lot. And I don't know if you guys talk about this a lot, but I hold a lot of double and triple leverage. I hold a ton. And the reason being is because when market dumps like this and you see SPY down 15%, you see the NASDAQ down over 20%, these double and triple leverages are getting absolutely destroyed. And I'm completely fine with that. And I'm very conservative with how I allocate and when I allocate. And the returns that I've been getting for the past couple of years and the back testing and everything that I've done for my assets under management for my companies, they're second to none. And I'm very young myself. I'm 23 years old. So I've got a lot of time, and all my partners for these companies have a lot of time on their side. So we're not worried about the downside risk. It's just about averaging down and getting my average cost as good as possible. And on the portfolio management side, I know a lot of folks talk about, and I'll be done here in a second. I'm sorry. I know a lot of folks talk about making sure you have downside protection for times like these. Well, a great average cost is great downside protection, and I utilize covered calls on all of the companies that I have because they're pretty big movers, except for SPY, QQQ, and Apple, and Microsoft, Nvidia, Tesla, AMD. My double and triple leverages. The amount of premium they produce is unbelievable. I know you guys were talking about Amazon and Shopify as well. I wouldn't, at the very moment, I wouldn't touch Amazon nor Shopify with a 700-foot pole. They're just not a part of my portfolio, and I don't like their upside. But again, the companies are still not doing poorly, but their stocks are not my favorite in the world. So that's quite a bit about me at the moment.
Awesome. Appreciate that. We'll definitely hit a little bit more into that. Excited to have you on these spaces for the first time. I do see you putting out a lot of my tweets and in the crowd a lot. So excited to hear a little bit more about that. And clearly from there, you know what you're doing. So excited to have a little bit more going forward. All right. Perfect. First of all, before I do give it back to my speakers to get into the real meat of the content, we did have a space crash last time. I'm going to bring it up, but I do just want to say for anyone down in the crowd or my speakers or anything like that, I did pin up the tweet above in the nest that we are live. You guys could just go in and hit the like button on that or leave a comment or anything below. If you want to retweet it, you can, but just liking it does a lot. It really, sends it out to all of my followers. Twitter's algorithm, they like engagement, and it will get sent out to everyone. So just going in and hitting the like button on that pinned tweet in the nest above will do a lot to bring people into the spaces. Huge shout out to that. And with that, I want to throw it back over to Simon and get us a little bit into the meat of this. I know Simon, want to talk a little bit specific for long-term investors looking at the yield curve and a couple other stuff like that. So Simon, the floor is yours.
Oh, thanks again, Evan. Clay, it's great to hear from you too. Welcome to the program. I don't know you from before, but it's nice to make your acquaintance here today. We're talking about the macro. We have to talk about the macro right now. And in fact, just last night, I chatted with Peru Saxena, who's over in Hong Kong, who kind of does a lot of work and looks at a lot of these kinds of things. And we were thinking about what this means when you look at some of the stuff that's going on in the American economy. It's huge and it's very significant, right? We just saw in April that the CPI, rose 8.5%. Inflation is at a 40-year high. It hadn't been that high since December of 1981. And when you think about stuff like this, you're like, okay, well, the Fed is going to combat inflation by tightening its monetary policy. And we've seen that with the Fed's announcement, even just yesterday, of a 50 basis point rise in interest rates, right? Fed funds rates up 0.5 percentage point. And the market immediately loved this. They said, oh, only 0.5 point. That's great. Stocks are really, really all in the green yesterday. And then we kind of come back to earth today as everyone's digesting what this means. But I think that there's something else that we probably should talk about. It's complex. It's off the radar of a lot of investors, but it's also important. And that is the yield curve. The yield curve basically plots out the interest rates that when the U.S. Treasury issues bonds, what are the interest rates that it's paying for them, for shorter term bonds and then also longer term bonds. And the 10-year Treasury note, as of yesterday, I haven't updated it yet for today, but it's right around 3%, which is clearly a sign that inflation and interest rates are ticking up very quickly. Actually, the 3% rate is up 100 basis points, so a full percentage point in just the last 3 months. And if we look even at the 2-year Treasury, that's at 2.6% now. That's up 130 basis points within the last 3 months. So rates are going up. This tends to constrict the economy, right? Borrowing is more expensive for businesses. It's not so much the macroeconomic climate where you can just go ahead and afford to be cash flow negative and step on the accelerator if you're a high growth company, because you could always just, issue debt at really low rates, or you could use your stock to issue equity to fund those losses. We're kind of in a new world now. But I think that even more interesting, and this is the one that I wanted to chat just briefly about, is something happened on April 1st. So about a month ago, here we are, Cinco de Mayo, before we get into our happy hours and margaritas, let's look back a month ago when on April 1st, there was an inversion of the yield curve, which means the interest rate being paid for the 2-year Treasuries was higher than that of the longer term 10-year Treasuries. And it happened right around 2.4%. So that was actually about 60 basis points ago. But that's significant because that's only happened 4 times in the last 25 years. Happened in 2019, it happened in 2005, happened in 1998 and happened in 1988. And when this happens, when you've got such a sharp increase in interest rates in such a short amount of time, like the Fed is pushing up very, very clearly right now, that typically is predictive of an American recession. In all four instances of the yield curve inverting, there was an American recession that followed afterwards. And traditionally, when you look by the numbers, it happened an average of 19 months later, right? So almost 2 years. It's not something that happens immediately. The economy is not going into the toilet next month or the month after that. But typically when the economy needs to slow down because interest rates are rising, it's predictive of an American recession. And so what does this mean for long-term investors or any investors for that matter? The knee-jerk reaction to this might be, hey, I'm out. I don't want to get into a recession. I don't want to invest in the stock market. This is bad, right? Interest rates are going up. The macro is unfavorable for equity investors. But interestingly enough, the stock market is actually very forward-looking and predictive of these things before the American economy follows with a recession like this. The stock market is predicted because people large institutions specifically are looking at a lot of these macroeconomic indicators. And that's why we've seen such a significant fall in the stock market that we have. And in fact, in the previous four instances that we said, okay, on average, 19 months later, the American economy goes into a recession, the stock market over that same period of time, the S&P 500 has averaged a gain over that year and a half of 29%. So this is an interesting divergence, right? Over the last four yield curve inversions, the economy has been going sour. We've gone into recession on all four of those instances as an American economy, but because the stock market is so forward-looking and we've already baked in this into the valuation of tech stocks, on average, a 29% increase for just the S&P 500. And when you look at the NASDAQ, tech companies, a lot of these companies that have sold off 50, 60, or 70% or more in the last 6 months, they're going to be up a lot more than 29% as well. And so if there's an optimistic takeaway that I can share with investors, it's been brutal. I mean, nobody likes to see the red ink in your portfolio that we've seen in the last 6 months. It's been intense. It's been sharp. The year of the tiger in 2022, it's been having its teeth come out with a vengeance. But I think that if you do think bigger picture and you think longer term and you start today and say, okay, past is the past, it would have been great to be all in cash and just put all of it right back into the stock market. It's very difficult to time the market. But if you're looking forward from where we are today, knowing that a lot of the bad news is baked in, knowing that the Fed's are going to do everything it can to not allow the American economy to go into recession, while still controlling this inflation that's 8.5% last month, that's a lot to digest in the macroeconomic picture, but it is not negative for the stock market or for equity investors right here. And I think we need to be mindful. This is not the time to go scream YOLO and take swings for the fences and say, risk on, everything's wonderful again. We've got to be diligent and we've got to do our homework. And I think that we've got to assume that the cost of borrowing money is going to increase. Capital is going to be harder for companies to get on their balance sheet. And so we're going to be starting to talk about things like return on invested capital, operating profit margins, things that, weren't really as discussed in early 2021 when it was growth at any cost. But I do still think as a long-term investor and as Seven Innovator, my Twitter moniker suggests, I really think innovation wins. I think that progress in markets always is going to win. And over long periods of time, again, back to fundamental revenue growth, profitable revenue growth over time, that's still going to be the name of the game here. And so let's not overly correct and think too much in terms of, what's the PE of the market right now? And do I need to get in and out over a 3 or a 6 month period? And do I need to get defensive? I mean, I think buy and hold is still here to stay. I still think a lot of the things that we're looking at as investors are still very much in play. It's an unfavorable macro, but where we stand right now is not unfavorable for stock market investors.
Awesome, Simon. I love that. I feel like it kind of goes back to the mantra. Well, first of all, I think you hit it there. The stock market is a forward-looking device. And now it goes to the mantra of Warren Buffett. When everyone is greedy is probably when you should be fearful. When everyone is fearful is probably when you should be a little bit more greedy in there. So definitely hear what you're saying, where stocks are down a lot, and the worst time to think, oh, I wish I had that protection is when your stocks are down a lot. Time to do it is before. So just kind of in general, how are we treating this market right now? Is it kind of just slowly moving in, waiting and seeing dollar cost averaging into these positions? Or is it kind of just letting the market settle out and knowing and waiting there, diligently watching it, waiting to put that cash in? So more or less what I'm asking is, have you started to slowly buy yet and take opportunities?
I have, but not in the places that you might think or that is kind of popular right now. The reason I say that is if you look at what the market is now, right? If you look at the top constituents of the S&P 500, it's tech companies, right? It's the big tech companies. It's the FANG companies. These have been the companies that have a larger and larger share of the S&P 500 index. And they've also been the market's best performers for several years since the crisis, since the financial crisis of 2008. It's been, the Googles and the Apples and the Amazons of the world that have been propelling the S&P's return, right? We always compare ourselves to the S&P 500, but Evan, we're starting to see a divergence now, right? The S&P, the FANG specifically, when we talk FANG, for anyone unfamiliar with that acronym, it's Facebook, Amazon, Apple, Netflix, and Google, which needs to be renamed because some of those companies have changed their own names now too, right? But it's big tech that is predominantly driving the returns of the S&P now. And the reason I say we're seeing a divergence is some of those companies are still handling themselves very well, right? There's been no slowdown in the returns of Apple, the returns of Alphabet, Google. They're doing just fine, but we're starting to see some real problems emerging at Facebook, at Netflix, and potentially even at Amazon now. I don't think those three companies are going to have the same next decade looking forward as they did for the past decade. And competition is rising for Netflix. Facebook is certainly facing some challenges in the age of the open internet right now. Amazon has got some blowback on kind of their advertising business, which is becoming more and more important. I think that it's time to really start looking into what is the businesses you really want to be in for the next 10 years, rather than just saying, I'm going to let it ride with big tech, FANG for the win. I think that the next 10 years are not going to look like we did for these last 10 years. And it's really it's causing us to put our thinking caps on. And the conversations we have is, okay, past performance not indicative of future returns at this point. I think that electric vehicles and climate is going to be a very, very big trend. I think space economy is going to be a very, very big trend. And the evolution of AI to be more data-centric rather than just letting the algorithms do their thing, that's going to be a really big trend. And we're going to, just like these large companies came to prominence and became the winners of those fields that they dominated, we're going to see a new breed that's going to emerge here. And when we check back in on spaces again, Evan, in 2032, 10 years from now, we're going to be talking about a whole lot of different companies than the big tech companies that are at the top of the S&P 500 index today.
I'm excited for those 2032 spaces. We already got some cooking, we got them planning. But I look back to the charts of the largest stocks, in 2000, 2005, 10, and those are just recent samples, and you can see the immense amount of switching, just names up there. Actually, besides Microsoft is the one that was really been up there over the last couple of years. Besides that, all of them have been changing. So I want to bring a couple of our other speakers into it, so we'll just touch on this last question there. You actually did answer what the question was going to be. You said you're looking in a couple other areas that excite you. I was going to ask about one of them if we wanted to go into it. You kind of gave us three of them, EVs, space, and then AI. I would love to hear a little bit deeper onto one of them. We don't got to go the full thing into it. I know we kind of wanted to touch on supercomputers 2 weeks ago, so maybe we go down that direction. But just would love to hear a quick, kind of why or anything in those areas that are exciting you right now. Yeah, definitely. I know it can be a lot. We'll give another space to go in deeper into it. But yeah, I'd love to hear a little bit there.
Yeah, maybe the trend that I'm most excited about right now is that space is being democratized, right? For decades, this was just something that NASA would do missions that would cost billions of dollars. They'd charge taxpayers to fund all of this. And there was so much fundamental research that went into that. But now with Elon and several others, doing ride sharing and getting the launch costs down, we're starting to see it's more affordable to get into outer space and start doing operations. And there are early innovators. Black Sky is one that's using satellites for monitoring the logistical operations. They're sending a whole lot of, what's the best path to take based on weather, based on other things. Monitoring, carbon emissions is a really, really big one that's going to get a lot of government funding right now. A lot of companies, telecom, what's the opportunity for satellite internet, like we've already seen Elon kind of talking about. I mean, things like this, used to be completely out of touch, out of reach for commercial enterprises, private companies to do. But now it is much, much more affordable. We've got launch costs down. And then the other thing that was really, really interesting last year is all the money that was raised in SPACs, because space is not cheap and launch is not cheap and building these things is not cheap. It requires a ton of capital expenditures. But last year was such an opportunity for a lot of companies to raise money at historically great times, to put that on the balance sheet. And now they're funded, right? Funding secured for what they want to do in the development and pushing this even farther. So the innovators are going to get even stronger. And now that funding is a lot harder in 2022 than it was in 2021, you're going to see a real divergence between those who raised money and were ahead of the curve and those who didn't take advantage of the opportunity are going to fall behind. So I really think you're going to see consolidation in the space economy. I think you're going to see a lot of new innovative business models that have come out of that. For a guy who loves to be a growth style investor, that's something I'm really excited about.
Awesome, Simon. Appreciate that. Definitely something we'll have to dig into on another Spaces. Love having you on here, and everyone in the crowd, definitely go in and check out the link in Simon's bio. Big shout out to 7 Investing. So awesome. Love having you on here, Simon. And with that, I want to keep us moving and slide it over to Brad now. I know you gave us a little bit on Shopify, but would love to hear a little bit more on a couple of the other stocks that you own and what's been happening with earnings this week, or any other direction you want to take us. But
no, I think earnings is a great direction to take it this time. So I'll shift to my actual holdings now that reported earnings this week. The first one I wanted to talk about, which we talked about a little bit a few days ago, but not much, was actually Match Group. So the news here is that Shar Dubey, who's been with the company for 16 years, is going to step down. The new CEO is going to be Bernard Kim. I just, as an aside, I really like when companies run this search process and find a replacement privately instead of announcing publicly the CEO is stepping down, and then 4 months later, now we finally get a CEO announcement. So I just want to say I think they handled that pretty well. But I wanted to give a quote from the CEO, the outgoing CEO now, on kind of where this came from, to make, or to kind of argue why it's not really all that concerning to me. So here's Shar. So during the IAC separation, which is what Match Group spun off from, it made sense for me to step in, provide continuity, and help guide the company through that process. I told the board then that I couldn't commit to being a long-term CEO because of where I was in my life and the things I wanted to do. I took over, and then the pandemic hit. And once we were out of the thick of the crisis, while the board hoped I would change my mind and stay, they are prepared to work through the succession process and ran a robust process. So this was coming for a long time. She's not a spring chicken anymore. She's been with the company again for 16 years. She's now going to stay on as an advisor. That mess up my signal, or can you still hear me?
It did for half a second. You basically cut out the word advisor.
Cool. Good to go now. So she's going to stay on as on the board. She's going to be an advisor. She's going to focus, and I quote, on the parts of the business that she loves, like process and products. And then Bernard Kim, I mean, hard to think of a better replacement in my obviously biased opinion. He was the president of Zynga for 6 years. He turned around that company, set it up, quadrupled the market cap, and prepared it for a Take-Two Interactive sale. He was the senior vice president of mobile publishing. Sorry, that was hard to say, at EA, and he was a director of sales at Walt Disney. So in terms of multiple products, multiple brands, mobilely native, but omni-channel, and then having several brands that are at different parts of this growth life cycle and this S curve, Zynga is all of those things, and Match Group is all of those things. So there are a lot of similarities between these two companies. They also successfully purchased and integrated several acquisitions over his time or his tenure with Zynga, which is very important to Match Group and its overall growth. They like to buy things, and they're going to continue to like to buy things, and that's important. So moving on to the actual results, the actual quarter was fine. The forward guidance was underwhelming, but the reasoning behind why the forward guidance was underwhelming wasn't, again, not all that concerning to me. So they were supposed to guide to around 19% growth. They guided to a midpoint of 13.5%, but this includes an incremental 5% revenue growth headwind related to foreign currency exchange and another 1% impact from the war in Ukraine. So they were gearing up to guide to about $845 million on an FX neutral basis. But before the historical strengthening of the dollar we've seen against yen, against the euro, and against the Turkish lira, which is a very important market for Hyperconnect, which is one of its companies. So that is really, and the weight is increasing. I wasn't expected to be this big of a hit. So that's really where this is coming from. Now, despite all of that, HIT continues to rapidly grow. They continue to expect 50 to 100 basis points in their key margin expansion, their adjusted operating income, which is really just adjusted EBITDA. They're still expecting 50 to 100 basis points expansion, and may get, and I quote, a little bit more than that. That's a quote from the CFO, Gary Swidler. But this is, again, despite Hyperconnect, which was an acquisition it made last year, weighing on margins by about 2%, and also Google, which is continuing to move forward with their forced in-app payment process, despite the fact that they continue to get sued by several governments around the world, which is also weighing on margins by another 1.5%. So this 50 to 100 basis points, which really just means 0.5% or 1.0% of margin expansion, really on an apples to apples basis would have been a lot more than that. The other things I want to point out, they posted a really interesting chart on Japan, which I really think highlights where they are in their macro recovery right now. So Japan is their second largest market, which I think is a surprise to some people. And they were in lockdown until late March of 2022. And when that lockdown lifted, Pairs and Tinder, which those are the two popular apps it has in that country, user growth and engagement just rocketed higher to pre-pandemic levels. So this is giving them some confidence that as South Korea and other key markets that are a little bit behind on the recovery curve continue to move forward towards normalization, that they will continue to find normalized operations. But they're not assuming any of that in their forward guidance, which I'm grateful for. Always love to be set up to under promise, over deliver. And it really seems like they are being as pessimistic and as conservative as they possibly can be here in terms of the quarter. Just want to scroll through my notes to see if I missed anything important. Buyback. They issued a $12.5 million share buyback, which 12.5. What is 12.5 times 70? It's over $100 million. Not massive, but they suspended the buyback actually when Match Group spun off from IAC because they wanted to get their net leverage ratios down below 3x. Now that's happened, so they can again lean back in to buybacks, which they're fully planning on doing, which will be another lever to pull for growing earnings per share. The other one I wanted to talk about, and these are going to be a little bit more brief. Match Group was really the most dense and most noteworthy report with all that news that came across. But Revolve Group, which has been absolutely crushed as a stock over the last few days, actually reported a phenomenal quarter. So 10% beat on the top line. They beat all of their profit metrics, but again, some people cited net income margin compression as concerning. I just wanted to point out where this actually came from. So I want to give you the exact number. Their tax rate in the year-over-year period was negative 6%. So they had a positive 6% tax rate impact on the year-over-year comp, which shifted to 22% year-over-year. So the net income margin compression is really predominantly related to that, which is why we saw things like free cash flow margin expansion and gross margin expansion year-over-year. But then we also have to keep in mind that Revolve pretty much paused the bulk of its marketing and its hiring spend during the pandemic. This is a brand that, and I quote, wants to sell things that make you look and feel your best. So if you're going out, if you're going to a music festival, if you're going to see that special someone, speaking of Match and Tinder, this is what they're really selling to. So you can imagine, despite this being an e-commerce platform, their heavy marketing presence at live events and what they actually sell made them a very large made the pandemic a net headwind for them. So growth has been comping over those extremely easy periods, which is why this company that's supposed to compound at 20 to 25% has grown north of 55% over the last 4 quarters. That continued to grow in excess of 30% as we enter the next quarter, which that is including very, very normal year-over-year comps, which is encouraging to think they're so far ahead of their long-term growth outlook, even as things get more difficult from a year-over-year perspective. But yeah, really, really positive quarter for them despite the stock reaction. I actually added yesterday, but the third straight quarter with a record sequential customer adds. They didn't raise their guidance, but they hinted at several times during the call that the cost outlook that they offered and the gross margin outlook that they offered is probably a safe assumption, and we could see some upside to it. record cash flow generation. I mean, there's not much to pick at aside from the fact that they are revamping operating expenses to capture this growth, which is why we got that massive 10% beat on the top line, and also the tax rate, which really weighed on net income margin, which people cited. But at the same time, earnings per share beat expectations handsomely. So there's really nothing to pick at all that much in my mind. I was honestly surprised by the stock's reaction, but surprised and coincidingly grateful because it gave me an opportunity to build out the position. So those two were on the radar, and then Green Thumb, which is a cannabis company and my largest cannabis holding. This is just in case anyone didn't know, this is going to be a tough quarter for the cannabis industry, lapping stimulus checks, which greatly propped up their growth, inflation weighing on discretionary spend, and also a delay in licensing in some states and medical states flipping to recreational. So we were actually supposed to see sequential declines in revenue. We actually saw stable revenue year over year. They doubled their EPS guidance. I shouldn't say double. They posted 12 cents in earnings versus 6 cents. So they beat by 6 cents. I guess it's technically doubling, but I should probably say it that way instead. And yeah, we continue to just wait for states like New Jersey, which are now flipped to rec, and then states like New York that are going to turn on, and states like Virginia that are going to turn on. All these states that are going to provide growth in the future, along with licensing restrictions getting a little less intense, which will allow for more shops and more growth in states like Illinois. But we're waiting for that. None of that has happened yet. That's all in front of us. And this quarter was essentially relying on same store sales growth in an industry where we usually see sequential declines between Q4 and Q1 for growth. So, I mean, the headline numbers didn't look all that good, but they weren't expected to look all that good, and they looked better than I thought they were going to. So really, really nothing of concern there. I actually added to my stake after that earnings report this morning on the pullback. I think that's it. Progeny reports after hours. That's my fertility benefits manager. They usually perform, or they usually deliver very inline results. They're not much of a beat and raise machine like we love to see, but I mean, it's a company compounding at 40% and trading at about 30 times EBITDA. So not really needing a whole lot of beat and raise to make those numbers work, in my opinion. But we'll see how they do. Elective care should be coming back, but it's coming back more slowly than some people thought. And we'll just see how kind of the fertility benefits field, which is inherently time sensitive due to biological clocks that tick, how much quicker that comes back versus other parts of elective care, which I'm optimistic about. But again, not a beat and raise machine. That outlook that they provided is probably pretty accurate, and we'll see how they do. But that's all I have in terms of earnings this week. Again, Shopify on the watch list. Am more interested in starting a position than I was 24 hours ago. If anything, nothing to be super alarmed about in the quarter. It wasn't good. It wasn't terrible. So yeah, that's all I got.
Awesome, Brad. Love all the amazing information that you always share. So I know, first of all, you do, for anyone who wants that a little more written out on those positions, I know you do put out that newsletter, that free newsletter every single Saturday. So I'm sure a lot of this stuff will be written out on there. Oh, but this is also being recorded, so you can come back and listen to this again if you want. I know last week was a very odd week for you in that you exited 2 positions and not something you do very often. I want to kind of ask you, have you been making any moves this week? Have you been redeploying some of that cash into other places? Yeah, have we made any moves?
Yeah, and I don't. So that bolstered my cash position. Finally admitting I was wrong on Teladoc and then Boeing as well. I exited. But I mean, I'm just in case anyone was wondering, I'm not perfect and I'm going to be wrong again. So while I say all these wonderful things about stocks, just keep that in mind that I will never bet anywhere close to 1,000. So please do your own research and reiterate and verify everything for yourself. But in terms of activity this week, it was really just adding to those 2 names. Match Group I was going to, but it didn't really give me a chance. Such an aggressive snapback off of the lows last morning or yesterday morning. But I did add to Revolve and I did add to Green Thumb, very small ads. And then also I've been saying over the last several weeks, I'm expecting a cash infusion, fortunately, that actually hit my account a few days ago. So the cash position is elevated, and I'm very comfortable with that being elevated right now. Kind of as Simon was saying, and I couldn't agree more, it's not time to go YOLO all in. It's time to wholeheartedly focus on the quality of our companies and at the same time respect all this macro uncertainty and just inch in at a snail's pace like I've done and like I'm going to continue to do. So the cash position is elevated. It's going to remain elevated. It'll probably dwindle down at a very slow pace, at a pace that some people find frustrating and annoying, but that's kind of just who I am and who I'm going to continue to be. And yeah, so a little bit of adding today, not anything crazy. Just really rolling with the punches right now and taking advantage of opportunities as they come, again, at an extremely slow pace.
Wait, did I hear you say unfortunately you had the cash infusion?
No, fortunately. If I said unfortunately,
Okay,
then shame on me, because I am quite pumped about the cash infusion.
No, that's what I would just think. Maybe it was just me, honestly, just dreaming or thinking of it. I was just saying that's super exciting. So, love to hear that. Love to have you on a little bit more in the near future, and we'll talk a little bit about that. Maybe even hear a little bit more about some of your thoughts and some final wrap ups. But I do definitely want to bring OBR into this, give them the chance to speak. It's been a while, and I appreciate you sticking by us. Yeah, OBR would love to hear anything you got for long-term investors. You can take any angle you really want with it. Could be any stocks you own reporting earnings. You want to do a deep dive into it. Could be anything of that nature. Yeah, floor is yours.
Well, thank you very much. First of all, Simon, I want to address all the information that you provided to us. What a pleasure it was to listen to you speak. Very hyper technical with all the numbers that you were putting out for the economy, the interest rates. I love your perspective. You and I think very, very similarly with everything that you put out this afternoon. I loved it, absolutely. And then Brad, the earnings reports, phenomenal. I am very, very excited to hear about all of those companies. I don't personally invest in them myself, but I try to educate myself the best I can in all of these different companies that are very innovative in their spaces and sectors. So listening to you all for this time, past about an hour or so, has been incredible. I really, really appreciate the information you guys have put out. So I don't want to be as complex and as thorough necessarily as the two gentlemen that spoke before me. I'm a very simple man in regards to how I do everything, my companies, my businesses, my investments, assets, everything. And for my acquisitions and equity investments, I go super deep in, just like Brad was discussing with these different companies that he covered. So I try not to do that. I try not to make my life difficult in regards to the consumption of information in the stock market. So I'm very simplistic. I try to figure out what I believe has true innovative value in the future, and I try to see whether or not it's at a discount. And I'm very, very simple with that capacity. Now, my individual security allocations is much lower in regards to my longer term. It's a much smaller percentage of my portfolio, but some of my largest holdings right now are Google and Tesla. And anytime I see Tesla down over 40+%, I'm adding to the position. And usually I wait for that point in time. Um, I am more of an active portfolio manager. I do a lot of longer term trading and longer term buying and holding. But for the individual securities, I know what I want, I know what I like, and I don't necessarily question or go too deep into the fundamentals or the earnings of the companies I hold. I know what they're capable of. And another very large position for me is Apple. Now, that being said, my individual security allocations are very much outweighed by my ETF allocations that I utilize. Now, primarily for my ETFs, I don't use funds, I don't get into bonds, I don't get into all of that. I'm very much ETF heavy, and the ETFs that I center my portfolios around are the S&P 500 and the Nasdaq via SPY and QQQ. Like, I'm a very, very simple individual. I don't get hyper complex with what it is that I'm doing, and everything that I do in regards to my capital deployed, capital allocated, is all percentage based. I sit down and I go over what's happened in the Nasdaq for the past 20, 30 years, right? Same with the S&P 500, and I try to see how how economic events that we are going to see in the future. Excuse me, I'm sorry, something just popped up on my computer. Um, I look at economic events that we've dealt with in the past and see how we could be currently dealing with them if we're going to see them again. So, for example, right now, I know we've dealt with interest rates in the past, and we've dealt with very, very high inflation. And just like Simon said, I mean, he hit so many nails right on the head. It was a pleasure to listen to him talk about how inflation and a potential recession based on the inversion of the yield curve and how that could play out. He was exactly right. Every single square inch of it was incredible. And I'm playing it very similarly. Now, I'm not, like I said, I'm a simple man. I think the yielding curve was provided to the stock market, to the world, just so that it could be inverted. So I know it's a hot take, but I'm simple in regards to my outlook with a lot. So if we're seeing a situation like that and the stock market's taking a downturn in the short term, then all that means is that everything that I would like to have is on sale. Very simply put. Now, having a bunch of companies on sale does not necessarily mean that they're a good buy and they're providing good innovative value to the future. So I'm very selective with what I purchase, which is why the majority of my portfolios remain around the S&P 500 and the Nasdaq and some of their top holdings. So I think once we get inflation under control with the deployment of the interest rates coming up here incrementally, and once we start to get here, probably in the next couple quarters, I think we're going to be just fine. I'm very excited for the third and fourth quarter of 2022. And even if the economy were to take a major hit in 2023, I do believe that the majority of what we could be seeing is priced into the market. So I just go off of I build portfolio management based models, and they're micromanagement and macro management heavy. And my models, all I'm doing is buying. I've been buying, and I got no problem. And I'll be buying until we crash. And if we crash, and I'll be buying below it. I've got no problem doing that because I know what I'm buying is providing me value, and I know the upside of what I've seen over the past 20, 30 years of what I'm putting my capital into. So I'm not worried about it whatsoever. And I also try to protect my downsides. I use options to lever my way back up when we see major pivot points that we've seen in the past in regards to 15% down, 20% down, 35.6% down with COVID, for example, which was very, very quickly bought up because investor confidence was unbelievably high during our last administration. It was beautiful to see. Not so much now, but overall, I've been buying for quite some time. I will continue buying. And my top choices right now in regards to what I'm deploying capital into, I've picked up a ton of Tesla in the 700s. I picked up a ton of Google between 23 and 2400, and I will continue buying if we drop lower. That's for the individual securities as of right now. My Apple position I haven't messed with. It's one of my long-term holds that I just run covered calls on for additional annual return. Microsoft, I've picked some up. NVIDIA, I have restarted a position after taking 70% returns off the table, up around 312. I have been buying AMD because I believe AMD still has multiples in regards to its percent return in the future once we get rid of all of the air quotes supply chain issues and semiconductor based supply chain issues. I think that's a lot of narrative. I know we're having issues, but they're doing the news networks are doing a great job of bringing the semiconductors down at better prices for all of us to buy. So I fault them for being so negative, but I also appreciate them for being so negative and dropping the stock price down so that there are at incredible deals. So, and then primarily, and that's individual securities for me, which is a smaller allocation. Moving into the ETFs, I mean, looking at QQQ being separating itself from SPY at about 7 to 8% difference right now, I believe, off the top of my head, in separation from how far SPY's down and how far QQQ's down. I'm absolutely just in love with how much we've dropped because that means my double leverages and my triple leverages are down quite a bit more. You know, TQQ's broken the 50% down. I'm picking up quite a bit. I don't care if it goes down further. I don't care if we see TQQ at $10 a share. I'm going to be a buyer all the same. And I'm going to pick up that leverage in large quantity if we ever get down to that point, if we decide to drop past $30 or $20 a share, for example, if we decide to come back or come lower, maybe to the COVID supports that we saw back in 2020, 2019. So I'm buying double leverages. I'm buying triple leverages here. Every other year, every 2 to 3 years, we see these triple leverages that are breaking 50% to the downside, which means obviously they've gotten 100% upside once the Nasdaq and the S&P recovers. I know that a lot of people don't like saying double and triple leverages in the same sentence as long-term investments. That's because the majority of folks don't know how to utilize them. So, and that's okay. That's hopefully what we're here for, right? So, that's pretty much what I'm dealing with at the moment. What I'm deploying, where I'm allocating. I know there's going to be a lot of fundamental news and a lot of news from the Fed, and a lot of information coming out about politics and policy and all this different stuff. You know, if the market goes down and it goes down to a point where we've seen it before, I'm buying. If it goes down further down, I'm buying more. And I'm not looking much at individual securities. I know that some of the mega caps have major fluctuation and major volatility in regards to like Tesla, AMD, Nvidia. They drop 30 to 40%. It's a buy for me. I'm not trigger shy at all whatsoever. but I'm very excited to see where we end up in the next couple quarters. And I think if we finish the year up 5 to 10% in the S&P 500, which would be a little bit over 500 per share, I'd be a very, very happy man. I'm usually doubling to tripling the S&P 500 every year because I'm leveraged, which means I'm also doing that close to that on the downside, but I protect my downside excessively with covered calls, and I'm not heavy on the downside as we fall with the double and triple leverage. So I'm usually about 5% worse than the S&P and about double to triple on the upside of what the S&P is capable of doing. So if somehow we pulled out a 15 to 20% year this year, which I'm not sure is likely, I'd have probably one of the best years of my career in regards to management. But I'm very, very excited to see what we do in the next couple of quarters.
You say you're 23 years old?
Yes, sir.
That is impressive. I'm 24, so shout out to the early 20-year-olds focused on this. But yeah, man, you are quite bright for 23 years old or for 63 years old.
Well, I appreciate that very much. That means a lot to me. I'm trying to swing up to bat to Brad and Simon here. They were incredible with what they had to say, and I loved hearing every word of it, as well as yourself. So I appreciate it very much, and I very much appreciate you having me on here. I love this so far.
I want to fact check on that one. I don't believe you're 23 either. I think you've been doing this for 23 years is more believable in my book.
Well, I appreciate that very much. I'm opening up a algorithmic firm here soon that does all my models algorithmically, and I speak to a lot of clients that are a lot older than me, and it's a lot of fun sitting across the table and having them expect about 6 to 7% a year, and I'm not about it. I don't think that's where we need to be, and I don't think that's what we need to be pitching people because it's just multiples of that is possible. But I appreciate that very, very much. I am 23 years old. I was born in August. My birthday's coming up this summer, and I'm very, very excited.
Wait, what day in August?
August 28th. I'll be turning.
I'm the 11th of 98.
My whole family's in August. August is the best month for birthdays and people, in my opinion.
There you go.
Yes, sir.
Yeah, so that was definitely surprising the age at the end. I'm 23 as well, and I feel like we definitely maybe sound a little different. Some may say. But appreciate very much what you were saying there. Definitely, I can't lie. I do fall a little bit into that area with holding leverage funds for the long term, where I don't necessarily believe in it too much. But I definitely would love to do a space where we can explore that a little bit more and kind of turn it into a discussion. I do know for me on that topic, it really kind of is just a lack of information. And I don't know if lack of information is just kind of what I've been said, and I know it is extra risky, but I haven't kind of digged into the deeper ways that they could be used for the upside. So maybe that's actually a really good topic for a space going forward. OBR, definitely appreciate you coming on here. Want to kind of kick us over into the wrap-up section of this a little bit. I want to start with you, OBR, and kind of just anything in this area, really just extra things you wanted to say, extra stuff that we can find what you're doing. If you wanted to go a little bit longer, just kind of because you were at the end and doing that, would love to have that. But yeah, floor is yours, and definitely appreciate you coming on.
Well, first of all, I appreciate that very much. And you let me know when you want to get into that conversation about double and triple leverage, and I will be there any day of the week, anytime. I would love to do that. There are so many people who are very much uneducated about what they are capable of doing. And it's just because the majority of financial institutions and advisors like to scare people away from them. And that's because they do require a decent bit of micromanagement. But I can tell you right now at 23, my retirement accounts, my business retirement accounts, SEPs, Roths, etc., they are all leveraged. I don't have SPY and QQQ in those. I've got double and triple leverage in them, and I sleep easy at night. It's very simple. If you look at, and this is for everybody else who's listening, if you guys look at the last 20 to 30 years of the market, you can look at the S&P, you can look at the Dow, you can look at the NASDAQ. Every single major drop that we have, you don't even have to know what it was for. Every single major drop, we get eaten up very quickly. And I give you an example. If you all are scared about a .com bubble, if you guys are scared about a 2008 crash, look at how you can prepare yourself. Create a comprehensive plan to make sure that you're taking advantage of a movement like that. Give you a personal example. The way that I plan for positions like that and the way that my models are built for my fund and the way that I build models for myself and show my clients with my consulting company is always have a little bit of cash on hand, right? If that cash can make you more money in 6 months with a crash than it would in 10 years if you were to have it actively deployed in something safer, then I don't care about inflation whatsoever. I'll give you an example. If, just to add to the double and triple leverages, if you look at SSO during '08, SSO is the double leverage of the S&P of SPY. If you look at SSO in '08, it was $1.66 at the base of the crash. 6 months later, it was up 500%. About a year later, it was up almost double that. So if you just leave yourself some cash and you pick up leverage when everybody's running for the hills and everybody's scared to death, you'll do very, very, very well. Very well. And it doesn't have to be a lot. It could be $5,000, $10,000. Some people will leave $100,000, maybe even $1 million at those levels. And they just say, hey, market's down 50%. That means my double and triple leverages are absolutely destroyed. They're worth pennies on the dollar. Once the market recovers, they'll be recovered all the same. It's the same exact thing, just 3x, downside or upside. So on the downside, it provides opportunity, and on the upside, it creates capital gains. So I'm all for it. And guys, there's no reason to be scared. There's no reason to be worried about the market. There's no worry. I know there's a lot of news networks, CNBC, et cetera, whoever you listen to, that says the word recession every 2 seconds. It seems like it's the only word that they know how to say. But if it happens, it happens. You might as well be prepared and have a comprehensive plan to make money from it. If it happens, it's going to happen. There's nothing we can do as individuals to stop it. So you might as well be prepared, and you might as well be well allocated and ready to allocate. If you have no cash on hand because you've deployed all your gunpowder to start out the year, you over leveraged, you over allocated. If you're sitting at 50%, you've got 10 to 20% of your portfolio still in cash for a major move to the upside. The next 2 years for you are going to be extremely bright. And that's my inflation hedge. I know a lot of people are saying, cash is getting destroyed with inflation. The market's getting hurt. Where do I protect my money? Well, market. The upside's unbelievable of everything that we all have been speaking about in this space. Some things are better than others. Some things provide better value. I have a different conviction from others in regards to what I put my capital into. But I want phenomenal returns, and I want to be able to sleep at night. And I want the people that I work with to be protected at the same time. So time is on my side. I'm well aware of that. And for clients that I have that are older, in their 40s and 50s, I'm obviously not as levered up as I would otherwise be for myself. But there's nothing to worry about. We still have the greatest stock market in the world, and one of the and definitely the greatest country in the world. So I'm not worried about anything moving forward. And I appreciate you letting me speak today. Thank you so much for that.
Awesome. Appreciate you coming on. Definitely appreciate you coming on and love what you had to say today. So thank you, OBR. We're going to keep it sliding and throw it over to Brad.
Yeah, not much to add for me other than what I've said. Revolve actually just got some revenue revisions higher after by only a couple percent, but I mean upward revisions on revenue is always preferred to downward revisions after an earnings call. So yeah, it was just reiterating, really good quarter. Stock will do what it will do, but I was pretty pleased with the results. Shameless plug for the newsletter. It's in the bio, single click subscription. It's all free, and I'll cover all these earnings reports and things like Upstart's new relationship with Salesforce, SoFi's new relationship in Latin America with MasterCard. A lot of interesting stuff going on this week that I will cover. And thanks for having me. Love doing these, and I'm sure we'll talk soon.
Started speaking on mute there. Awesome, Brad. Love having you on these. Excited to have you on a bunch more of these and hopefully some more spaces this week. Brad did say it there. Make sure you go and check out the newsletter in his bio. It's a fantastic read. If you liked anything that Brad was saying, you want that really on paper and in front of you, it's a great way to get it each and every single Saturday for free. So big shout out to Brad and the newsletter in his bio. Before I throw it over to Simon, I do just want to come in and say, first of all, make sure you're checking out and giving all of our amazing speakers a follow. Definitely do appreciate them. Huge shout out to Wolf Financial for being the co-host on this space. We're going to come to him after Simon for a little bit, but if you want more of this type of free content, you could definitely be following the Rippers account, but if you want 40 hours a week of this free live spaces content, make sure you're following the Wolf Financial, the only verified account up here. Definitely a good follow. But with that, I want to throw it over to Simon on the same type of wrap ups. And yeah, definitely was our pleasure having you on the space. And Simon, definitely want to get you back on a bunch more of these. And again, I do apologize for the intrusion, might I say, on the start.
Well, we'll get Elon on the next one of these. We'll have some words with him about this, and then Twitter Spaces and the infrastructure. But I always enjoy these, Evan. Thank you, Goff too. Thank you, Wolf, and for always having me. Clay, it's great to meet you. Brad, always a pleasure being on this with you. I always love to hear your analysis, which is so thorough. Yeah, it's man. I mean, the sector rotation is another one of those financial media buzzwords. But it's true, right? Like even just at the end of February, and this has been even more pronounced since then. But at the end of February, over the last 12 months, we've seen $200 billion of inflows into large blend funds, and then another $100 billion into large value funds. And where has that been coming out of? It's been coming out of large growth funds. So what is very clear, the data is showing us that for the last 12 months, since the first quarter of 2021, we've seen large institutions who are managing tens of billions of dollars of client funds moving in a mass migration, right? Lion King stampede out of growth and out of large tech and into risk-free or lower risk assets, whether those are money market funds, bond funds, or even just kind of more value focused companies. And I think that the pendulum is going to swing the other way here. In my opinion, I mean, the way the institutional world works is clients are eventually going to say, hey, I'm tired of risk off. Claire's mentioned it earlier about, clients don't always just want to see 6 or 7% returns a year. Eventually, they're going to start comparing themselves to their peers that are saying, hey, why is this other fund getting their investors 9 or 10% or 10 or 12%? And to do that, you necessarily have to get out of defensive stocks and into growth again and into innovation again. And that's the thing that I'm really excited about. I think that now is just such a unique opportunity to front run that and to look at where you think the puck is going. I'm excited about being a growth investor in the second half of 2022. I think that over the next 2 or 3 years, like you said, the sector rotation is going to swing the other way. Great opportunity for long-term investors.
Extremely well said.
Awesome, Simon. Thank you for that. Huge shout out to 7 Investing as well. Link is in Simon's bio. Definitely check that out. But I want to bring my amazing co-host into it. Definitely would have loved to heard from you a little bit earlier, and I say this every single time on long-term investing space, but I'm going to give you a question in there or throw something at you, keep you on your feet, on your toes. But yeah, Wolf, how we doing today? Anything we got to look forward coming forward? Or anything you want to comment on this space as well?
Yeah, Brad, I saw that. Was that a hand up there?
Yeah, I completely forgot to mention Penn National Gaming reported very inline quarter, no real surprises. I'll cover it Saturday, but thumb very sideways for me, and no alarming things to mention.
Brad, what are you doing tomorrow at 4 p.m.? You want to come on FinTwit Friday?
Sounds fun.
Talk about some Penn National? Awesome.
Let's do it.
All right, perfect. Well, get another guest for that, and floor back to you, Wolf.
Okay. Yeah, absolutely. So first off, fantastic space. OBR, glad we got more of your team into this. I know that we've been chatting over the last couple of weeks. Sounds like it went spectacular. I'm glad it was a great fit. Brad, Simon, it was a pleasure chatting with the two of you. We have a ton more stuff coming up today, so I have to put out a tweet soon. I'll do it right after this. Our next space is going to be a live trading / power hour space. We're going to have on Richard Moglin, as well as Exclusive and one other gentleman on our space at 3 p.m. EST. We're going to roll right into live earnings. We'll probably start on that around 3:45, 3:50. We have a big panel coming on for live earnings today, so definitely do not miss that one. That's going to roll in at 4 p.m. EST. There's a lot of big names that are reporting. After that, we're going to roll right into a real estate space at 5 p.m. EST. That's going to be Real Estate with Lex. At 6 p.m. EST, we're going to keep the real estate theme going for another real estate space, but it's going to be real estate in Web3 and crypto. So something to look forward to there at 6 p.m. And then at 7 p.m. EST, we're going to roll right into another space. That space is going to be, we're going to chat about the other deed or the other side that you may have seen with the Bored Ape Yacht Club, where they released that they had their single biggest volume day ever. There were, I believe, hundreds of millions of dollars of ETH traded on that day. And we're going to discuss how the ecosystem is being shaped. And then the last space for the day will be at 8 p.m. EST. And that will be with the after party NFT. So essentially, there's about 6 more spaces to come today. We'll start at 3 p.m. EST and we'll run straight until 9 p.m. EST. So 6 more hours of content to be looking forward to. You can come in at any point. We're just going to keep the space open throughout the evening. And as long as you are following the speakers, myself, you will see these spaces on your timeline. So yep, that's all I got. Big shout out to Stock Market News and the Bullish Rippers account. Bullish Rippers account has been cruising lately. up to 22.1 thousand followers. I do a couple spaces on their week. So if you haven't already checked it out, the Green Raccoon account is a great follow. The content on it is awesome as well. That comes from Stock Market News. And yeah, that's all I have for this one. Looking forward to the 3 p.m.
Awesome, Wolf. Appreciate that. Yeah, definitely. If you do enjoy this type of free live content, a lot of great tweets, everything like that, and there's also an awesome newsletter that Stock Market News, do write. So make sure you go in and check out. Make sure you're following this account. We're doing a bunch of really cool stuff from it. So always looking to do more. And yeah, so appreciate everyone for joining in. My speakers, all the amazing guests. And I'm excited to the next Ripper space that we have. I feel like it will be at this point next week, but we'll be on a couple of spaces throughout the day. We have, as Wolf was saying, so much there. And we got Into It Friday tomorrow as well. So a lot to look forward, a lot of content coming out there. We really appreciate everyone for coming in, and we'll see you on the next one.